Well, Canada's inflation rate rose more than expected in October, lowering the chances of another jumbo-sized rate cut from the Bank of Canada next month. The consumer price index rose 2%, while core inflation was also higher. Joining us now for a closer look is Sam Chai, Vice President, Active Fixed Income Portfolio Management with TD Asset Management. Sam, thanks very much for joining us. Lots going on in the markets. First of all, I want to start off by getting your take on the Canadian inflation data, which clearly progress has stalled in October.
Well, Anthony, I'll start by just saying that, overall, I think it's very clear to say that we had a pretty strong October CPI. So headline CPI came at 2% versus expectation of 1.9%. Average core CPI came roughly around 2.6% versus 2.4% expected. If we look at the underlying components, we've seen strength in the shelter component. That is more or less expected because of the one-time increase in property tax for October. But we have also seen upside surprise in other components, including clothing and transportations. So when we look at the 3-month annualized core CPI trend, it has picked up meaningfully from last month's 2.1% to now 2.8%. So obviously, one data point is not a trend make, so we don't expect sustained pickup in core inflation strengths. But I think what it is clear is that post this October CPI print, the Q4 overall CPI is likely going to overshoot what Bank of Canada expected in their last meeting, and that will materially reduce the likelihood of a 50 beeps larger rate cut in December meetings. Although we cannot fully rule that out because we still have some important data coming in the coming weeks.
Okay, that's my next question. What does this do for that 50 basis point rate cut? Because certainly markets seem to be ratcheting those expectations down. What's your outlook on interest rates or the Bank of Canada's call in December?
So to think about that question, maybe we can first talk through what's the current market expectations. So post the CPI today, markets pricing roughly 35% chance of a 50 beeps cut still, and then 65% chance of a 25 beeps cut. And in 2025, market pricing 2 additional cuts by Bank of Canada, bringing the terminal rate to somewhere around 2.8%, which is slightly on the upper end of where Bank of Canada see the long-term neutral rate to be. And then let's look at the data, right? Since the October Bank of Canada meeting, we just talked about this strong upside surprise in inflation in October. So that is likely an overshoot to Bank of Canada expectations. When you look at the GDP data as well as labor data that we have got in the prior weeks, those are roughly on par with where Bank of Canada expects. But when you also look at on the currency side, which is another factor to consider for them, Canadian dollar versus US dollar has depreciated roughly around 3%, and that likely led to a bit more loosening of financial conditions. So overall, that is some of a picture of a stronger macro picture for Bank of Canada. And so, I believe the base case now, post the data, is more of a 25 beep rate cut by Bank of Canada in December. We'll still be getting, very important GDP data and labor market data before the next meeting. But I think absent of very negative surprise from those, the 50 beeps cut seems less likely now. But I think what is more clear is that this is more a question in my mind of the speed and pace of how Bank of Canada return policy rate back to neutral. I think that path is clear, direction is clear. Next year, we are going to go back to this 2 to 3% neutral rate range. It's just more how quickly we get there.
Okay, now we mentioned we've got the Bank of Canada coming up in December. Of course, we also have the Fed, the last rate decision in December rather. What are you expecting there, and what kind of divergence are you expecting between the Bank of Canada and the Fed? Because right now, when you look at the Bank of Canada rate and the Fed rate, there's about 100 basis points difference. What do you see in terms of the divergence going forward?
So as you pointed out, Anthony, Bank of Canada and Federal Reserve currently has roughly 100 beeps of policy divergence. And the underlying driver is quite clear. It's the diverging domestic macro picture. Year to date, Canada has been seeing more disinflation progress. We have been seeing more sustained and longer weakness in labor market. And our economic data on the activity side has been very subdued, despite pretty aggressive easing from Bank of Canada already starting from June. the market's current expectation for Federal Reserve for their December meeting is also a 50-50. And that is after the stronger than expected CPI data that we have seen this month. We estimate that the core PCE data this month, which hasn't been released, will also be on the stronger side and overshooting what the Federal Reserve has forecasted in their prior economic projections. And before the next meeting, we will also have another round of CPI, labor data, which are critical. And Chair Powell himself has hinted at the possibility that the Federal Reserve may want to slow down the pace of easing as well.
Right, he said the Fed is in no hurry to cut interest rates.
We are hearing more of those communication of late. And so it is understandable why the market has this 50-50 current pricing for Federal Reserve as well. But coming back to this question of policy divergence, restraint, how much of a role it plays in Bank of Canada considering, that is a very popular topic as well. Recall that we had this discussion earlier in the summer, which has died down a bit when Federal Reserve delivered a 50 bps cut, but now is reigniting again, right? One of the key considerations for this question is how does this divergence lead to sustained Canadian dollar weakness and how it translates into a trade channel? Obviously, it's very hard to quantify how much currency depreciation can directly translate into CPI numbers. Thankfully, Bank of Canada has published a paper that proposed a model that basically, the finding is that roughly 10% depreciation of Canadian dollar can translate into a 30 beeps increase in core CPI. So to put this into context, year to date, we have roughly 6 to 6.5% depreciation in Canadian dollars. That's roughly 20 beeps increase in core inflation. So that's not too material, especially when you consider that the core CPI in Canada is already near 2%. So I believe that policy divergence below 150 beeps will not be a key constraint on Bank of Canada considerations, and they will continue to focus on the domestic macro picture. And Senior Deputy Governor Roger lately also commented on this point, and she stated that Bank of Canada does not see itself as close to that policy divergence limit yet. I would caveat that by saying that it is more when we go to next year, in Q1 2025, when we see more policy divergence opening up, and when we see also that Bank of Canada policy rate is that much closer to neutral rate, when this likely could become a more important consideration and limitation on how much further they want to bring rates down.